Good morning, everyone. For those who have tuned in today, we'll be talking about rebalancing small cases, the concept of why we are rebalancing small cases, the advantages and benefits of doing so today. So, all of you might already be aware of what small cases are and what small cases as a concept. So, for those of you who are not familiar, small case is a basket of stocks which is designed using a particular idea or a theme or a strategy in the market. Now, if you've already invested in any of these baskets through the HDFC platform, we are going to teach you why you should be consistently maintaining your portfolio using regular rebalances. Now, before we start the session, I would like to inform all the attendees that whatever questions they may have, feel free to post it in the chat box and we will be taking up these Q&As at the end of the session today. So now I want to keep this a very live interactive session, and we will also be, along with the presentation that we've made today, also take you on the HDFC ecosystem of the small case portal, and we'll be showing you live demos as and when required. Now, let us first take a look at what is rebalancing as a concept. Now, we can define it as the process of buying and selling parts or portions of your portfolio in order to set the weightage of each sector or asset class back to its original state. Or it can also be defined as adjusting the stocks or weights in your portfolio based on the reasons behind, creating or curating the portfolio in the very first place. Now, to explain this in a very simple format, what we are going to try to do is to basically understand what a rebalancing could mean. Now, let us say that you have purchased a portfolio which is made up of 10 different stocks, which is based on a particular idea or a theme. Now, let us say that the portfolio that you have purchased is based on momentum or is based on growth as a fundamental underlying idea behind how the portfolio has been curated. Now, rebalancing the portfolio basically means that over a period of time, the very first set of stocks that you purchased might no longer be fitting the criteria or the agenda with which the portfolio has been curated, which can be growth or which can be momentum. Now, let us say out of these 10 stocks, we remove 4 stocks out of the equation after stipulated period of time. It could be 3 months, 6 months, 1 year, whenever it is. The logic behind removing 4 stocks which are no longer fitting the criteria and replacing it with those stocks which are fitting the criteria is called as a rebalancing. Now, let us take a look at who is rebalancing my portfolio. To explain this better, let us head over to, for those of you who have tuned in, I would request all of you to take a look at your portfolio and basically try to understand who it is that has designed this portfolio. Now, every portfolio gets designed by a SEBI registered fund manager. Now, this SEBI registered fund manager could be HDFC Securities in your case, or it could be any other third party entity like Windmill Capital on the HDFC platform. So now these SEBI registered fund managers are basically tracking your portfolio all the time to ensure that the portfolio remains consistently healthy. Now, these fund managers, or what we term as investment advisors, they are basically tracking the portfolio, and when they feel that the portfolio needs to be changed according to the market cycles, according to the market conditions, or according to a variety of other criteria, basically at that point of time, they issue something called as a rebalance, where the old stocks are removed out of the portfolio and new stocks are added into its place. Now, this is called as rebalancing, and the fund manager, the SEBI registered fund manager who is managing your portfolio, will be in charge of rebalancing your portfolio. Now, the next key advantages or rebalancing in a nutshell that we are going to consider are, the first criteria for it will be that the old stocks and ETFs, as we all know, stands for exchange traded funds. So the old stocks and ETFs which are no longer fitting the investment criteria of the portfolio get removed from the portfolio. So now let me try to explain that with a better example. Let us say that the portfolio that we basically went with was a momentum based portfolio. So initially when we would have invested in the portfolio, most of the stocks in the portfolio would be momentum based, which means that they are expected to perform very well in a bull market condition. Now, let us say that out of these 10 stocks, 3 to 4 stocks have already played out their momentum. Let us say that the capital appreciation or the price appreciation was supposed to be X% in those particular stocks. And now the percentage momentum or the gain momentum has already played out in those 4 stocks. Now, what the fund manager is basically going to do at this point of time is to remove those 4 stocks which have already fulfilled the particular price targets, would be to, after removing the stocks in the portfolio, the fund manager would basically try to replace these stocks with newer stocks coming in which the momentum is yet to play out. Similarly, we may look at or consider portfolios which are growth based, for example. Now there are certain set of stocks that we can look at which will be growth based, and if they have already played out their particular momentum in the market, then these growth based stocks in the entire set of portfolio needs to be removed and replaced with other stocks. Now this concept of removing the old stocks is going to be the first step of the rebalance during the rebalance. Now what's going to happen next is that the new stocks which are going to fulfill the criteria of the rebalancing will be added into this particular portfolio. Now, why is it so crucial to ensure that rebalancing is happening in your account? Now, one of the major reasons why is that the research analyst who is managing the portfolio post a rebalance, once the rebalance has been initiated by the investment advisor, the advisor is expected to only track the portfolio with the new stocks that have been added along with the existing stocks that were already in the portfolio. So the old stocks which were removed from the portfolio will no longer be tracked by the SEBI registered advisor, which increases the risk of owning the old stocks if the client or the customer does not rebalance the portfolio during the stipulated time. So it is always advised that the very reason behind subscribing to a portfolio gets justified with regular rebalances being done by customers all the time as and when required. So let us now take a look at some of the key advantages of rebalancing the portfolio. So the first advantage is that the portfolio always stays healthy, which means that the advisor who is tracking the portfolio ensures that all the event-based news is being tracked for the stocks that are available in the portfolio, that the stocks that are already in the portfolio are still fitting in to the investment philosophy of the portfolio. The philosophy could be growth-based, it could be a conservative portfolio, it could be thematic, idea-based, whatever it is. The fund manager is now ensuring that each and every stock in that particular portfolio is still maintaining that criteria. So that is crucial to ensure that the portfolio stays healthy and that some of these stocks have, basically the idea behind it is that none of these stocks have stopped fitting into that criteria. If so, it is the fund manager's duty or the investment advisor's duty to basically remove these stocks from the portfolio. So now that the fund manager is continuously monitoring your portfolio, the expectation is that the portfolio always stays healthy. Now, one of the second advantages is that the user has complete control at the time of rebalancing. So on the small case platform, what we have to understand is that users control what stocks comes in and what goes out of their accounts. Now, let us consider that there are 15 stocks in a portfolio or in a small case basket that you've selected on the HDFC platform. Now, at the time of rebalancing, the users are notified asking them to approve some stocks being removed and some more stocks being added into the portfolio. Now, what is going to happen is that you as the user has been given complete control and authority as to whether or not to approve this rebalance or even modify this rebalance. So let us say that, for example, out of 15 stocks in your portfolio, during this particular rebalance, 6 stocks were to be removed and 6 more stocks were to be added in its place. Now, what is going to actually happen is that at the time of removal of the 6 stocks, you as a user will be intimated by small case as to whether or not you would like to proceed with that particular rebalance. So if you're not happy with the rebalance, or if you're not happy with 1 or 2 stocks that are being removed from the portfolio, and if you personally want to hold it for a longer period of time, you have all the flexibility to do so as a user of a small case. So you would have the provision to basically try to retain those 2 stocks and even get to decide what new stocks will be added onto the portfolio. So now let us say that there are 6 stocks being replaced by the investment advisor, and out of the 6 new stocks that is being added into the portfolio, let us say that you are not happy with 1 or 2 stocks that is coming into the portfolio. You can very well remove that at the time of rebalancing, which ensures that only the stocks you like, they're coming back into the portfolio. Or at the same point of time, even as much as customize the portfolio in a way that you can reduce or tinker with the weightage of the stocks that are coming into the new portfolio. So this is what we mean by users having complete authority and control at the time of rebalancing. Now, the next important crucial aspect to consider is the performance of the portfolio. Now, every portfolio that you see on the HDFC small case ecosystem, the performance of the portfolio has already been mentioned there, be it the historical performance, be it the live performance against its respective index. If the portfolio is not rebalanced in a timely fashion, then the performance of the portfolio might not really reflect what the platform is showing, what the small case platform is showing. So as the reason for this is that you will still be, your portfolio will still have old stocks because of lack of rebalancing, which will have a different performance metric when compared to the newer stocks that have been added into the portfolio. So now this creates pricing discrepancies, which leads to visible changes in your portfolio's performance against what is being displayed on the platform and against what is being visible in your actual trading and demat account. So if you wish that the portfolio's performance be similar to the one that is being shown on the small case platform, we request all the users who have subscribed to small cases to consistently keep updating your portfolio as and when a rebalance notification is issued. Now, let us take a look at how it is that we rebalance a portfolio. So how do I rebalance my portfolio? So it's a very simple concept. When a rebalance is being issued by an investment advisor or issued by the fund manager who's managing your portfolio, so in that case, we issue a rebalance notification on your small case app and also via email. And if you have subscribed to WhatsApp alerts on the small case platform, you will also be intimated via WhatsApp as to a rebalance notification. Now, whenever this rebalance notification is issued to you, what is expected out of you is a one-click approval process. So once the rebalance notification has been issued, all we expect you to do is open up the small case platform, use your HDFC credentials to log into the platform, and basically approve the rebalancing as a one-time exercise. Now, once this is done, what is going to happen is that the stocks which had to be liquidated or the stocks which had to be sold will automatically get sold and newer stocks in its place will be added. So there is no requirement to manually buy each and every stock or sell each and every stock from the user. So this process has more or less been automated, and it is a seamless experience for you as a user to consistently rebalance your portfolio as per the latest directions given by the investment advisor. Now, let us take a look at when do I rebalance my portfolio. So now every portfolio has its own set of philosophy behind it. So there are portfolios which are ETF based, where the idea behind holding a portfolio is that the portfolio requires minimal rebalance and is reviewed only once in a year. So there are other portfolios which are momentum based, which are growth based, where the portfolio needs to be rebalanced very consistently owing to the recent trends and changes that are happening consistently in the stock markets. So in such cases, the rebalancing could happen as soon as monthly or even quarterly. So there are other portfolios on the ecosystem where we even have weekly rebalance issues, weekly rebalance notices put out. So what is expected of the user is to basically try to understand when your portfolio is going to get rebalanced. So what we expect you to do is try to get in touch with your HDFC relationship manager, or log into the small case platform, click on the fact sheet button over there and try to figure out when the rebalancing of your next portfolio or of your portfolio is next going to be. So there is a stipulated date which is predefined on which the rebalancing is going to happen, and that data is mentioned on the fact sheet of the portfolio that you've subscribed to. Now, all we request you as users to do is to be aware of the date, and on the date, maybe check for notifications on your email, or if you have enabled notifications on your small case app, you will be notified, and only on that particular date will a rebalance be issued. So all that is expected is that you approve the rebalance, and once that is done, the portfolio gets rebalanced and is now healthy and good to go again till the next rebalance gets issued. So for those who require portfolios where lesser rebalances, let us say that you require portfolios where you do not want consistent rebalancing to be of a priority, then you can go ahead and look out for portfolios which are being reviewed annually on the small case platform. If you wish to participate in portfolios which are being very consistently rebalanced and reviewed by these investment advisors, then kindly look out for portfolios on the HDFC small case platform, where you can find rebalance notifications or review notifications as soon as when the period of rebalancing is probably monthly or quarterly. So with that said, we believe that the concept of rebalancing and why rebalancing is crucial has been thoroughly covered in this small presentation. So with that said, we will open up this forum for question and answers. So whatever questions you might have, it doesn't matter how small or how big it is, kindly post it over here, and we will be able to explain as to why you should be rebalancing or any other queries that you currently have. So with that said, let us have a look at the chat box. If you have any questions, please feel free to drop it right there.
Dear participants, if you have any questions, please click on the question mark icon on your screen and type in your questions. I repeat, please click on the question mark icon on your screen and type in your questions. You want to take the questions now, or you're ready to take the questions now, right?
Yeah, we are ready to take the questions now.
We have a first questions. So when are the dates of this rebalancing? Is it on the particular portfolio or particular small case, or is it done one date all the clear small cases?
Okay, so
how will we know which dates?
Sure. So in order to explain that, I believe that my screen is visible. I have logged into the HDFC ecosystem on the small case platform. You can come down to hdfc.smallcase.com, and over here you can click on all small cases. So you will be able to find a list of the portfolios that are available here, which a HDFC securities customer can basically purchase. Now, for each of these portfolios, there is a stipulated review or rebalancing date. For example, let us take a look at one of the portfolios. So we can pick any portfolio that we like. For example, for the time being, let us pick a portfolio called All Weather Investing. Now, All Weather Investing has been live on the HDFC and small case platform for roughly 3 years now. If we want to figure out when the rebalancing is going to happen, or when the historical rebalancing has happened for this portfolio, all that the customer is expected to do is land over on this page and click on the fact sheet button over here. So once you click on the fact sheet icon, you'll basically find a downloadable PDF in which the entire set of details about this portfolio is being mentioned. So now here, when we scroll down, we see something called as important fields, in which the last review date of this portfolio and the next review date of this portfolio will be mentioned. So now, as we can see, All Weather Investing is a portfolio which has a review frequency of a quarterly basis. What this means is that this portfolio is being reviewed by the fund manager. In this case, it is Windmill Capital. the fund manager has last reviewed this portfolio on the 30th of September of this year, that is 2021. And the fund manager is, or the investment advisor is basically going to next review this portfolio on the 30th of December, that is 2021. So basically any portfolio that you can think of or any portfolio that you can see on the platform over here have a predefined date in the fact sheet as to when the next review date is going to be. So now let us also take a look at the Samvad 2078 portfolio. So here, this portfolio has been very recently launched and is one of the flagship portfolios of the on the HDFC platform. Now, if we click on the fact sheet over here, and if we scroll down, we will be able to see when the next review of the portfolio is going to be. So this portfolio has a yearly rebalance cycle, which means that the philosophy with which this portfolio has been designed is that it requires minimal rebalances, or it requires minimum, minimum continuous monitoring by the fund manager, because the portfolio has been by nature designed like that. So for this portfolio, the next review will happen on the 25th of October of the year 2022, which is the next year. So we have both aggressive portfolios where the rebalancing or the review basically happens on a monthly basis or a quarterly basis, and we do have passive portfolios where continuous monitoring is not required because of the nature of how the portfolio has been designed, where the review or the rebalance happens on a yearly basis. So I hope that that answers the question.
We have a similar question by Mr. Falguni Khairwala. He's asking, are these rebalancing dates pre-decided, or are they also dependent upon the market behavior?
Okay.
Is it market oriented, or is it just pre-decided?
Sure. So this is a very interesting question. What happens is that these dates have been predefined by the investment advisors. So if it is a quarterly rebalance, then there are fixed schedules as to when the rebalancing is going to happen. That is once in every 3 months. So let us say today is the 26th of November. So if a portfolio were to get designed today with a quarterly rebalancing philosophy, then the 3 months from today, that is the 26th of 3 months from today, will be the next rebalance. 3 months from then exactly will be the second set of rebalance, and so on. But this does not necessarily mean that the fund manager will not be able to rebalance the portfolio in case of some adverse conditions that are happening in the market. So now let us say that we have designed a portfolio which is a yearly rebalance portfolio. Now let us say that the portfolio was designed today, and the next review of the portfolio is going to happen 1 year from today. Now let us say that there is a market changing event, or there is significant volatility expected to happen in the market in a very short term. So in that case, we do have a provision called ad hoc rebalancing, which an investment advisor can make use of and issue rebalance notifications on priority on an immediate basis. So the fund manager or the investment advisor need not necessarily wait till till the next review date to actually rebalance the portfolio. But we would like to reiterate that in a majority of the cases, the portfolio gets rebalanced only on the review date that has been predefined. So ad hoc rebalances are very rare and do not usually tend to ever happen on the ecosystem. So this is something that I would like to put across.
Our next question is from Mr. Deepak. He's asking, how is the brokerage charge? Is it only charged on the buy and sell? And how during the rebalance is it charged again?
Okay, so this is something that I would like to redirect the user to contact his HDFC Securities Relationship Manager. He will be able to talk about the brokerage aspects of things better, and the communication can come directly from your HDFC team, which is servicing you.
We have a question from Vijaya Setaraman. He's asking, what happened to small cases which are personally designed by the user and not designed by HDFC or the other company? Does HDFC look into those rebalancing of those, or they have to be done by the user themselves?
Got it. So in case a portfolio has been curated and self-designed by the user themselves, in that case, HDFC or small case will not be able to track the portfolio and will not be able to issue rebalance notifications, because the philosophy with which the user has designed the portfolio is not clear either to HDFC or to small case. So in that case, we will not be able to do anything about it, and there will be no rebalance notifications issued. Rebalance will be issued only for portfolios which have been designed by investment advisors on the small case platform. And it is not small case or HDFC, but the investment advisor who has to take a decision on rebalancing the portfolio.
Our next question is, can a user sell half of the stocks in the small case, like a partial? If there are 10
Got
stocks in small cases, can he just
it.
exit out of 5 and stay invested in 5 of them?
Okay. So this is something that I would like to address in detail. So now let us say that you have a stock of, you have a portfolio of 10 stocks. Okay. Now, a partial exit basically means, let us say that the minimum requirement or the minimum investment requirement of the portfolio was 30,000 rupees. Now, let us say that you have invested 70,000 rupees over a period of time into the portfolio. Or let us say you have invested 90,000 rupees. Now, if you want to exit the portfolio partially, then a partial exit consists, a partial exit is basically made up of exiting every stock on a partial amount. So exiting 40% of the portfolio means exiting each and every stock by 40% of its weightage. But exiting 4 stocks out of 10 stocks that you own is not considered as a partial exit on the small case platform. So if you exit 4 stocks from out of the 10 stocks that you hold, then it is no longer the very same portfolio that you're holding, because it creates significant disturbances in how the portfolio's philosophy was originally designed and what the user is trying to do by trying to remove 40% of the portfolio. So that is something that is not recommended, and that is something that you should refrain from doing unless and until you're very sure of what you're doing and a solid explanation behind why you want to do it. So unless the user is unsure of those things, it is expected that the user does not exit 4 stocks by himself and term that as a partial exit. So if you want the portfolio to get rebalanced, kindly wait for the review date. And if a rebalance has to be done on that date, the fund manager or the investment advisor is going to communicate that to you through notifications. All you have to do is approve that notification. So until then, users and viewers, for the users and viewers today, I would strongly recommend not to indulge in speculative activities by trying to remove stocks or add stocks into their portfolios by themselves, because it varies the performance of the portfolio significantly from what is being claimed on the platform.
There's a follow-up question to the same one. Is
Mhm.
somebody exits 4 stocks out of 10?
Mhm.
Would it be still considered a curated small case? That would mean that would HDFC would be monitoring that particular portfolio, or would it be considered as a user curated portfolio?
So we do not have a terminology for it. If you do decide to exit 4 stocks out of the 10 stocks that you have in the portfolio, so in that case, we will still be monitoring it in the sense that when the next rebalance notification is being issued by the fund manager or the investment advisor, you are expected to give your approval for it. At that point of time, the portfolio can rebalance itself to its original state. If you do not do that, then I would say, since the control lies with you as the user, we will not be able to do anything. And at that point of time, it is not exactly considered as the same curated portfolio that we are managing on the small case platform, because even though the portfolio name might be the same, the portfolio has been tinkered around with and the holdings have been exited by the user through his or her own discretion. So in that case, no, we will not be in a position to track or monitor or deliver the same returns or the same performance that is being displayed on the platform here.
Our next question is from Mr. Mukesh Shenai.
Mhm.
Asking, while rebalancing, if there's a difference in amount,
Mhm.
we get the extra money or we have to pay for it? How does the money difference of money is been adjusted.
Okay, so what happens is when a rebalancing is being issued or when a rebalancing is being thought out, the investment advisor is very aware as to what kind of capital requirements should be there. So generally what tends to happen is there will be there will not be a provision where the rebalancing is happening where 5 or 6 stocks is removed from the portfolio with a valuation of 20,000 or 30,000 and new stocks are being added in which have a value of 60 or 70,000. So that is not going to happen, and extra capital in order to facilitate that is not going to be a regular occurrence for you. So that is something that I would ask the user not to ever worry about. If a rebalancing is being done, then it is expected that the investment advisor uses more or less the same extra amount that is available after selling a part of the portfolio. So now let us say that out of 10 stocks, you've liquidated 4 stocks. The cash that is generated because of liquidating these 4 stocks, the free cash that has been generated will be more or less the same cash that is being used by the advisor to purchase the next set of 3 or 4 stocks. So that is how rebalancing happens. So I would request users who have this question not to worry too much about it.
I think we have covered all the questions that have been asked.
Mm-hmm.
I think we have covered all the questions that have been asked.
Mm-hmm.
Just a minute. I'll just go through the list once and then.
Sure.
One question is from Mr. Shishishuran Kumar.
Mm-hmm.
He's asking when you do a rebalance in a particular portfolio, what do you continue with the same theme, or on what basis do you decide which one to buy and which one to sell? Is it like you change sectors or you change the stocks?
Okay. So now let me explain that with a detailed example for everybody to understand. Now, we have different types of portfolios on the small case platform. It could be growth based, it could be a conservative portfolio, it could be thematic. For example, we have a portfolio which is purely based on it. So the name of the portfolio is electric mobility, where we invest in those stocks which tend to do well, which have a strong exposure to to the electric sector in India, or the electric vehicle sector in India. So if the demand for electric vehicles increases, then these set of stocks are set to benefit out of it. So we have another portfolio which is momentum based, where we invest in those companies which have a very strong price momentum during bull markets. So this portfolio is set to benefit when a bull market is happening in the broader markets. So each portfolio is designed with a certain philosophy in mind. Now, let us take the example of the momentum portfolio. Now, let us say that this portfolio is made up of 7 stocks. This small case, or a basket of, the small case basket is made up of 7 stocks. Now, let us say that over a period of time, the investment advisor realizes that the first 2 stocks that were purchased have already played out, which means that if a 30% momentum was expected in these 2 or 3 stocks over a period of 3 months, and these 2 or 3 stocks have already delivered the 30% and are not expected to have any more upside momentum left in the eyes of the investment advisor, then what is going to happen is that the advisor is going to sell or recommend selling these stocks from the portfolio, and he's going to add those stocks which are expected to start their momentum journey right now, which have an upside momentum to it. So in this entire process, the philosophy with which the portfolio was designed, which is purely momentum, it is not related to sectors, it is not related to balance sheets of these particular stocks. It might not be related to the idea or theme. For example, we are not going to consider whether or not this is from the pharma sector, whether or not this is from the auto ancillary sector. there could be a variety of reasons behind why these stocks are coming into the portfolio. But the philosophy with which this portfolio was curated was just one idea, which is momentum. So if momentum gets played out in one particular stock, and if it fulfills that criteria, and if that stock is being removed, then the next stock which is going to get added is going to get added with only one concept or one philosophy, that is momentum. So the philosophy of the portfolio remains the same, which is going to be momentum based. So it doesn't matter how many times the rebalancing happens. Every time a rebalance is issued or every time a rebalance is happening, the next set of stocks which get added are going to are expected to be momentum based stocks. Similarly, let us say that we have a portfolio where we are basically looking at dividend based stocks to curate that portfolio. So it could be something like a dividend aristocrat portfolio, which is also available on the platform. So here we invest in those companies which are consistently increasing their dividends. It could be on a quarterly basis, yearly basis, and so on. So now let us say that one or two of these stocks out of the 10 stocks in the portfolio, let us say, for example, one or two stocks stop paying out dividends or their dividend growth actually starts decreasing. Then now it is no longer fitting the criteria with which the portfolio was designed, which is to put in those stocks which are consistently increasing their dividends. So now what the investment advisor is expected to do is to remove these stocks and add in those stocks which have started consistently increasing their dividends. So the overall philosophy of the portfolio, no matter which portfolio you choose, is going to be the same after every rebalance. In fact, the very idea or concept of rebalancing is to make sure that all the stocks are following the set rules of why the portfolio has been curated in the first place. That is to ensure that all stocks in the portfolio are fitting into the investment philosophy. So I believe that this question has been answered in a detailed way. If you still have any queries about that, you can post it in the chat box.
We have one last question from Mr. Falguni Kherwala. Like, won't one lose an opportunity if rebalancing is done on a prefixed day rather than the market based? Like in mutual fund, a fund manager takes the decision based on the markets. So how different is from the mutual funds?
Sorry, could you repeat the last line, please?
So I'll repeat the question. Wouldn't one lose an opportunity if rebalancing is done on a prefixed day? If you compare it to mutual funds, where the fund manager takes rebalances his portfolio on the basis of the market conditions. But over here, it is done more on the basis of a pre-decided date. So wouldn't you lose the market opportunities?
No. So what is expected to happen is the user is expected to go through with the rebalancing. Now, what generally happens is, let us say that you have, let us say that you tend to ignore a particular rebalance. So in that case, yes, you do lose the opportunity to participate in the growth of the portfolio as per the new stocks that are being put in. Now, what is going to happen if you completely decide to ignore rebalancing as a concept, or let us say you're late for rebalancing or you do not want to do a rebalance? At that point of time, yes, the performance is not going to match. Now, I would not like to, in a sense, if I were personally holding a portfolio, I would always ensure that for the health of my portfolio, I'm going to consistently rebalance it. Now, your question is more aligned towards, is there going to be a missed opportunity if I don't rebalance? Then yes. Now, why is it that we do not have automatic rebalance like some instruments in the markets where we are automatically rebalancing your account without your consent? Now, there is a SEBI regulation which states that when the investment advisors are rebalancing the portfolio, the user's consent needs to be taken. And also on the small case ecosystem, we are giving flexibility to users to maybe try to decide whether or not they would want to participate in the old stocks, or whether they would participate in the exit of old stocks or participate in the addition of new stocks. So in order to ensure that the user is being given that control, an approval is required from the user as a set process or mechanism to continue with the rebalance. So that is the reason why you see that notification and that approval needs to happen from your end. But if you decide to miss the approval for whatever reason it could be, then you will be repeatedly notified, in the sense that you will get emails from small case and you will have notifications on your small case login, where you will be able to see that the rebalance is overdue. So we would expect you to rebalance it as soon as possible. But if you do not rebalance for quite a couple of maybe weeks or months and so on, then naturally you will start seeing differences in the fund's performance in your trading and demat account versus what is being shown on the or displayed on the small case ecosystem. So yes, I believe that that answers your question in a very broad way.
Thank you, Pranav. I think you've answered most of the questions that have been put up. We'd like to thank you for the wonderful information that you have given. Any closing remarks before we close?
Yes, so I would reiterate and I would request all users who have attended the session today to go back to log into your HDFC platform, try to figure out which small case basket you're holding, try to find out, go to the fact sheet of that particular small case basket and try to figure out when your next rebalancing is slated to be. If you haven't already rebalanced your portfolio, I would request you to log into the small case platform through your HDFC login credentials and basically try to rebalance your portfolio as soon as possible. If you've already rebalanced and you're already maintaining a healthy portfolio, please ensure that you're tracking your next rebalancing date, or you've switched on your rebalance notifications, and as soon as you get the rebalance, ensure that that is being done from your end. So that would be the closing remarks from my side.
Thank you, Pranav. With this, we'd like to call the webinar close.
Sure. Thanks a lot for having me. Take care, guys. Have a nice time.